Most people believe market crashes begin with numbers, with charts turning red or headlines announcing losses. Yet the reality is far quieter and far more psychological, because long before prices fall, the human mind begins searching for safety, and that search quietly alters behavior across millions of individuals at the same time. Imagine an ordinary investor opening a phone app during a normal afternoon and seeing the market slightly down. Nothing dramatic, perhaps a few percent, yet something subtle happens internally as the mind begins asking a question that has little to do with mathematics and everything to do with uncertainty. And that question is simply whether the decline will continue tomorrow. This small moment of doubt rarely feels important, yet across an entire population, it becomes the earliest stage of a market panic. Because financial markets are not machines driven purely by numbers. They are systems built from human expectations interacting with each other. The core concept behind most market panics is not the fall in prices itself, but the feedback loop created by uncertainty spreading between investors. When prices move slightly downward, individuals begin to interpret that movement as information about what other people might do next, and the mind is remarkably sensitive to signals of collective behavior. Behavioral economists have long observed that humans tend to rely on social proof when uncertainty increases, meaning that when the future becomes difficult to estimate, people instinctively look toward the actions of others as a guide for their own decisions. Inside financial markets, this tendency becomes amplified because every participant is simultaneously watching everyone else, interpreting small signals and adjusting their behavior accordingly. This creates a simple but powerful mathematical pattern where individual caution multiplies across the entire market. If a few investors reduce risk by selling small portions of their holdings, prices dip slightly, and those dips then act as signals for other investors who may already feel uncertain. Each decision remains individually rational because protecting capital during uncertain moments feels responsible, yet the aggregate effect produces a cascade in which thousands or millions of reasonable decisions combine into a large collective movement. Economists sometimes describe this as a coordination problem, where individuals acting independently unintentionally synchronize their actions. History shows this pattern repeating across very different eras and technologies. During the early days of stock exchanges in the 19th century, traders gathered physically in crowded rooms, yet similar waves of panic emerged when uncertainty about economic conditions spread through conversations and rumors. More recently, the same psychological mechanism operates through digital screens and instant financial news, yet the underlying behavior remains strikingly consistent because the human brain has not changed as quickly as financial technology. From a mathematical perspective, the market often behaves like a network system where each participant influences others indirectly through price signals. When confidence is stable, this network distributes risk calmly, allowing prices to adjust gradually as information evolves. When confidence weakens, however, the same network becomes sensitive to small disturbances, meaning that minor changes in sentiment can travel quickly across the system. What appears externally as sudden panic is often the visible surface of a deeper psychological shift already spreading beneath the numbers. Understanding this dynamic reframes the idea of market volatility from something mysterious into something deeply human. Prices do not simply fall because numbers demand it. They move because millions of individuals continuously reinterpret risk, safety, and the actions of others. Recognizing this pattern does not eliminate uncertainty, yet it reveals that many dramatic movements in financial markets begin not with catastrophic events, but with ordinary human instincts responding to ambiguity. Seen from this perspective, market panics become less about sudden disasters and more about the natural interaction between psychology and complex systems. Financial markets are vast networks of human expectations, and when those expectations shift collectively, the numbers simply follow. The charts may display the movement, but the true origin lies quietly inside the decisions of countless individuals navigating uncertainty together.